Hey fellow stock guardians, it's Monday, May 3rd, 2021. I'm Hoda, co-founder and CEO of StockCard, reporting to you from a mixed stock market. I took a look at the stock market indices mixed results today, dug into why FedEx and UPS stocks jumped while several social media stocks dropped. The stock market indices started the month of May with mixed results. It wasn't a good start for the Nasdaq index that started the month in the red. Despite the mixed result, however, the market isn't too far from all-time highs. The companies have been on a hot streak in beating the earnings expectations. According to FactSet, for Q1 2021, with 25% of the companies in the S&P 500 already reporting actual results, 84% have reported a positive EPS surprise, and 77% of the companies from the S&P 500 index who reported have announced a positive revenue surprise. That indicator by itself is enough to explain why the stock market indices have hit new all-time high records recently. Shares of FedEx were up almost 5%. Remember when FedEx got beaten down by Amazon after Amazon decided to terminate its partnership with FedEx? At the time, investors assumed FedEx is headed to its doom. However, a cash-rich, profitable company such as FedEx has the power to glide through the downturn and come out of it even stronger. We did pick up a few shares of FedEx for a StockCard's beaten down portfolio back then, and so glad we did that. Today's stock price jump comes after a rating upgrade by financial analysts from Wolfe Research, upgrading FedEx to outperform from peer perform. Overall, the rise of e-commerce and the world's transition to online shopping has been a growth catalyst for FedEx and similar companies such as UPS, who was also up more than 4% today for similar reason. Shares of social media platforms such as Pinterest and Snap were down more than 4%. Similar Twitter's share were down more than 1%. Most social media platforms are suffering from the impact of the reopening. People have less time to sit at their computers and surf the web now that they can gradually get out of their homes. Naturally, the year-over-year user growth or user engagement figures would look awful for these platforms, and you can see the effect on the company's stock prices. Generally, I'm bullish on these stocks' future. Yes, short-term they're down, but investors tend to forget the addictive nature of social media platforms. None of them were platforms that were created during the pandemic. They all were thriving and quite engaging social media platforms for different segments of the population. They will last the post-pandemic reopening slump. One way to take advantage of this situation is to look for social media-focused ETFs. If you look at the left-hand panel on the company's stock cards, you can see an ETF with social media focus named Global X Social Media ETF, ticker SOCL. The most prominent social media platforms are among the top holdings of this ETF and could be an easy way to play the recent social media price drop. If you choose to invest in SOCL, remember that the fund has had a great 2020, and while its price is off of its all-time high, it is still quite higher than where it was just a year ago. So that's the risk if you invest in this ETF. By the way, Joseph Hogue and I both updated our respective portfolios today. Joseph published his monthly portfolio update. I added my commentary to my stock picks this month. So if you are a VIP subscriber, make sure to check in with Bowtie Nation and roll with our CEO portfolios. If you haven't already done so, please give StockCard a try, research as many stocks and ETFs as you want, and consider following a few successful investors by visiting the stock pick page on the StockCard platform. Don't forget to sign up for a 14-day free trial with promo code ROLLWITHOURCEO, all lowercase and in one word. And as always, help us grow the StockCardian community by liking, subscribing, and sharing these daily market recap reports with your fellow investors. I'll see you tomorrow.